U.S. Treasury cash pile hits $1 trillion first time since April 2021. The U.S. government's Treasury general account has climbed to roughly $1 trillion for the first time in just over 4 years, with about $300 billion of that build sitting on top of the pile in only 3 weeks. Cointelegraph flagged the figure on May 4, 2026, citing Treasury daily statement data. The TGA is the federal government's checking account at the Federal Reserve. When it grows, cash leaves the banking system and parks at the Fed. When it shrinks, that cash flows back into private accounts. A $300 billion swing in 3 weeks is the kind of move traders watch because it tightens dollar liquidity in the background, regardless of what the FOMC is doing with rates. Why this specific number matters: April 2021 is the last time the cash balance sat near $1 trillion. That period lined up with peak post-pandemic stimulus runoff, before the debt ceiling fight of 2023 forced the account down to single-digit billions. Treasury rebuilt the balance through 2024 and 2025, but the pace of the recent refill stands out. Roughly $100 billion a week into the account, sourced from tax receipts and bill issuance. Liquidity watchers care because the TGA is one half of the stealth QE equation. The other half is the Fed's reverse repo facility, which has run down close to zero. With reverse repo no longer providing a liquidity buffer, every dollar that moves into the TGA is a dollar coming out of bank reserves. Bank reserves are the marginal funding for everything from money market funds to leveraged equity positions. The crypto reaction so far: despite the drain, crypto is up. As of May 4, 2026, Bitcoin trades at $79,952, up 2.3% over 24 hours and 2.84% over the week. Ether sits at $23.72, up 3.06% on the day. The CoinMarketCap Fear and Greed Index reads 48, in neutral territory. That rally is notable because the textbook reaction to a TGA build is risk-off. Higher cash balances at the Fed historically correlate with weaker performance in tech stocks, junk bonds, and Bitcoin. The fact that BTC is grinding higher against the headwind suggests either that crypto-specific flows, ETF demand, corporate treasury accumulation, regulatory clarity bids, are absorbing the macro pressure, or that traders are positioning ahead of an expected drawdown in the TGA later in May. Tax season inflows typically peak in late April and early May, then unwind through the summer as the government spends. If the cash balance starts falling again over the next 4 to 6 weeks, that liquidity flips back to the banking system. Traders who lean into that pattern have been buying risk assets into TGA peaks rather than selling them. What it means for stablecoin and on-chain activity. The TGA build is also a Treasury bill story. To rebuild the cash balance, Treasury has been issuing short-dated bills at elevated volumes. That keeps front-end yields sticky and gives stablecoin issuers like Tether and Circle higher returns on their reserves, since both park the bulk of their USD backing in T-bills and reverse repos. Tether's Q1 2026 attestation showed an $8.23 billion reserve buffer all-time high, with the lion's share earned from T-bill yields. A $1 trillion TGA peak suggests that Q2 attestations from the major issuers should look similarly strong, assuming bill yields hold above 4%. For users who hold stablecoins to spend through cards or to park between trades, the practical effect is steady backing. The flip side is that the same dynamic keeps borrowing costs higher on DeFi lending markets, since on-chain lenders compete with off-chain Treasury yield. The debt ceiling wildcard, one detail that complicates the picture. The U.S. is approaching its debt ceiling again. If Congress fails to raise or suspend the limit by the X date later this year, Treasury will be forced to draw down the TGA aggressively to fund operations. That is the opposite of the current build. And historically, it has been a tailwind for risk assets, including Bitcoin. The 2023 debt ceiling drawdown coincided with a sharp BTC rally from $26,000 to over $35,000 between June and October. Whether the same script plays out in 2026 depends on how the political timeline lines up, but the setup is similar. Cash balance peaks, drawdown begins, dollar liquidity returns.